As the markets grind higher, some high dividend stocks are also coming back in vogue as the chase for yield is back on. Dom Chu's back at headquarters to break it all down. Hey, Dom.
Well, Melissa, so far this quarter, traders have been dealing with a lot more volatility than they've been used to for a while now. And downside volatility has put many value-oriented stocks, industries, and sectors back into focus. Those are the stocks that really haven't gotten a lot of love or attention for the past few years. And dividend payers have fallen into that discussion. But as markets have fallen, at least some investors have turned towards these higher relative dividend plays. Just look at the S&P 500 Spider High Dividend ETF, that ticker SPYD. It's a fund that invests in high dividend paying stocks within the S&P. Since the end of September, the fund has gained just shy of 1%, modest for sure, but look at its bigger cousin, the Spider S&P 500 overall ETF, that ticker SPY, which is down over 4% in that same time span. That trend has played out as investors have gotten more defensive and less focused on momentum-based stocks like those in tech and communication services. You've got utilities, real estate, and consumer staples. They've been the three best performing sectors on a quarter-to-date basis, while energy, tech, and consumer discretionary have been the worst. That also means that the relative valuation of those bigger dividend-paying sectors has gotten more stretched. Just take a look at the consumer staples sector, which now trades at around 18.5 times expected next year's earnings. Compare that to the tech sector, which now trades at around 16.5 times forward earnings, and the overall S&P, which trades at roughly 15.8 times forward PE. So, Melissa, it's not to say that dividend payers are a crowded trade, but they've definitely been on a magnet, if you will, for investor money during that recent market turmoil. Back over to you guys.
All right. Thank you, Dom. Dom Chu in the newsroom. Well, our next guest says there are a few high dividend names that could help you pump up your portfolio into year end. The chart master, Carter Worth, is over at the plasma to break it all down. Hey, Carter.
Hey, thanks. So just thought we'd look at some sort of really long-term charts and then focus on two names, one quite good, one bad, but staying away from utilities and REITs as picks because it's obvious, yes? I like them both. So this is since the 1990 recession, a 28-year chart, and we all know the importance of compounding. You've got the S&P here, and you've got the total return with dividends reinvested, basically a double. Now, what if I add the following? Now, take a look. You've got here the S&P 500 Dividend Aristocrats Index, well-established old line companies that have paid quarterly dividends on a regular basis and make every attempt to raise those dividends. And of course, this really speaks to the power of total return and yield. With that, let's look at a few things that are sort of obvious here. Top chart is the utilities over the past 2 years, and the bottom chart is relative performance. Obviously, in a bullish phase, a defensive area like this will underperform. But what has happened of late, and everybody knows it, is that the utilities for the first time have moved above the downtrend line that's been in effect the past 2 years. That's a very important development. You also have what I would call a well-defined head and shoulders bottom, and the bet here is that this is going to continue to outperform. And then finally, when the market and utilities were coming off in October, we know that the relative performance, which is opportunity cost, was straight up ideal. So it's the same for REITs. We can do the same chart, putting the same line, but the principle is in effect. As this is selling off, and that's the important thing, and it sells off with the market in general, and it's all about opportunity, it is going straight up relative. And also, again, we are above the downtrend line, and that's key. All right, two stocks. Cisco. I might have three on here, we'll see. Cisco, you know, big tech is overdone. This is sleepy tech, old tech. And what I think you've got here is a fairly well-defined set of tops, and this stock is toying with the prospects of breaking out above those highs. I like this a lot. I think it's both offensive and defensive. Pepsi. You can draw the lines many ways. Some people like to call it head and shoulders. Some people like to call it cup and handle. But again, you've got the circumstance where well-defined tops at a common level, and the bet is that we're going to exceed those tops, break out. Relative performance is tremendous, and so forth. And then finally, one that's tempting. It's got the highest yield of this basket, 4.5%, but it's not tempting at all. There's something very, very wrong. In fact, I know some people think they're ultimately going to cut the dividend, and that this thing is a classic break-in trend. It has all the look of a top, and if they cut the dividend, listen, not good, very, very bad.
Carter, come on over.
Thank you for that.
Stephanie will bring the chair in.
You think maybe in 2019 we can get back to when you
Welcome, my friend. Chance.
Zero chance.
Zero chance. What did I say? Did I say
Not you. It's just
Whether I'm going to ask if you come over to the desk.
Mel's in charge.
For
You guys got to get used to
Carter,
that.
it's a slam dunk that he comes over. Okay, so Carter, does it say anything about the broader markets if you're predicting that real estate and utilities, those are the sectors that are going to outperform
so what
relative?
we know is right there, as something ages, you first get bifurcation, right? In the U.S. market, we know that financials have never been improved all year. We know industrials have rolled, materials. As the market kept going higher, crowding into fewer and fewer idiosyncratic growth names, whether it's an ISRG doing robots in the operating room or a Microsoft. And then one at a time, they've taken those out. And the final part of that is people acting very defensively. So you have people crowding into Coke and Pepsi, Church & Dwight, Clorox, in addition to utilities and REITs. And these are companies, in many cases, which are not good valuation and don't offer great growth potential. It's simply a I have no other choice kind of posture. And often, it's not that unwise to do.
broader market, CBW. Today's price action, obviously, something could happen tomorrow. We could be up again. But did today's price action give you pause at all? Should we have held the earlier gains? Did today tell you anything?
I think it was very sloppy. So at one point, we know that the Russell was negative on the day. The transports were negative on the day. We know the BKX was negative on the day at one point. And there's something that's awfully impetuous and euphoric about a gap. There was actually a gap in the futures. That's exceedingly rare. Something that trades almost 24/7, it's very hard to get a gap. That gap is very likely to be filled. And then there's also this. Remember the Monday, that October 29th, that low? We ricocheted, right, about 7 sessions from 2603 to about 2815. And then we gave it all back. This ricochet looks awfully similar to that prior ricochet. I just don't think it's got legs.